Look into my eyes. What do you see? What do you see? So I dip my toes in the water and it takes me farther out to sea. So I dip my toes in the water and it takes me farther, yeah, you take me farther, baby.
What is going on, everybody? What's good? What's good? What's good? We are going to be getting this thing going in about 8 minutes. So go ahead, send out the notifications to your team chat so we are officially live. And we got a very special back to the institutional basics training today. So chat will not be opened to everybody. It's only going to be open hosts and panelists. And I'll actually be disabling the Zoom chat for a large portion of today's training. So today is really a day to lock in, really a day to take notes. And so go ahead, send out the messages to your team chats, drop some screenshots of you being on today's session, and we're going to get started in 7 minutes. So trust me, you're going to want to make sure your teams are here live. Of course, the recording will be accessible, but we will be doing a specific Q&A session halfway and at the end of today's training. We'll be on here for about an hour and a half. So let's go ahead. Let's let our people know. I know it's Friday evening. A lot of people are probably going out, partying, but today we're dialing it in and doing a super high level training. So let's let our people know, as I was a little bit last minute in terms of sharing today's training time, which is on me, and I take full accountability for that. So y'all help me out. Let's pack this Zoom out, and we're gonna get started, like I said, in now 6 minutes. So 8 minutes after, that's when the training is getting underway. See you guys then. Enjoy the music. ladies and gentlemen, we are going to get this session started very shortly here. I just forgot my water in the other room. I came back just on time, was like, all right, ready to go. And I'm realizing I don't have my water. So give me 30 seconds to run, grab my water, come back, and we're getting this thing underway. Again, last minute opportunity to send the link out or let your teams know that we are officially live. Okay, so like I said, 30 seconds, we're getting this thing going. Final countdown is on.
Journey. Come with me on this journey. I hear home in that bass. Let me take you on a journey. Come with me on this journey. I hear home in that bass.
Alrighty, ladies and gentlemen, water acquired. We are ready to go. And I am excited for today's session. If you guys are excited to be here, if you're excited to be present live for today's Back to the Institutional Basics training, go ahead and let me know in the chat. And drop in the chat where you're tuned in from as well. For those of you that are tapped in, we've got people tuned in from all over the place as always. And so I'm happy to shout out those of you guys that are here live. You know, shout out to the different people, different places that are tuned in on today's call. We love to see it. And we got, let's see, we've got Johannesburg, South Africa, Jamaica. We got Devon, UK. Let's go. Calgary, Alberta. We've got, let's see, Serbia in the house, Ecuador, Dubai, Cameroon. We got London. We got Boys ID. We got Cam Loops. What's going on, Dayton? Good to see you, brother. Shout out to Dayton one time, moving his schedule around to be here. I know it was last minute promotion on my side. So, hey, those of you guys that are meant to be here live today are here live. If you're watching this on the recording, shout out to you for taking the time to review this. And this is going to be, hold on, I got to figure out why I can't turn my camera on here. Give me a second, you guys. Okay, there we go. Sweet. Should be locked and loaded and ready to go. Shout out Bolivia. We got Philippines, Slovakia, Nigeria, France, Estonia, Nebraska in the house. What's good, Blake? We got Czech Republic. Winkler, what's going on, David? Good to see you, brother. We've got people tuning in from all over the place. But before we get into the training, because this is a training that we haven't done since the first ever stream that I did with Economy, which was back in July of last year. So it's been, I think it's been like eight months, right? 8 months, something like that, since we've done the training that I'm going to be giving today. Now, before we get into the training, I have to preface this with a couple things. Yes, disclaimer is one of those things. We're going to get into that in a second. But before I do that, you're going to want to position yourself to fully absorb everything that I share in this training, whether you're here live or on the recording. So make sure that you are in a place where you're not going to be disturbed for like the next hour and a half. Okay. It might be difficult. Okay. And if it means you have to go back and review the recording, that's totally fine. But I promise you, if you can just lock in with me for the next hour and a half, this will be, and I can say this with confidence because I've seen it for myself and so many other traders, hundreds of other people around the world, but this will be probably the most paradigm shifting call you've ever been on. Okay. And there's material that I'm actually going to share that I haven't shared, or I didn't share the first ever session that I did with Economy back in July of last year. on this training today. So this is going to be, a training that I think personally will be one of the best that I've ever done personally, ever delivered personally. Of course, these sessions, for those of you guys that are here regularly, typically we're looking at market outlook, market updates, and we'll allude to the training that I'm going to give today, but at a very, very surface level. It's not as deep, it's not as in depth as what we're going to be going over today and tomorrow. And yes, the recording is going to be posted to the ECA. All right, and accessible for people to review. So make sure that you're in a position, like I said, where you're not going to be disturbed for like the next hour and a half, hour and 15 minutes or so, and have a notebook. Okay, white paper, blue ink. Yes, there's science behind blue ink being the ideal and best way to retain information, and be in a position where you're actually able to draw some diagrams today. To draw some things into your notes, because what is most effective for retention of information and also getting to a point of, we talk about the levels of learning. Sometimes on these sessions, there's 4 different levels. Your goal should be to get to a state of unconscious competence. Okay, which is, and you don't have to think about it. And the only way you can get to a state of unconscious competence is by being at a conscious competence level where and you have to think about it, but you're actively applying what you're learning over and over and over again, and also observing people that are already at unconscious competence. That's the only way you yourself can get to unconscious competence. So by drawing diagrams, you're not just taking in the information visually, you're not just writing notes, not typing. There's a big difference here. Not typing notes, writing notes. Okay, big difference. Drawing diagrams, big difference in taking screenshots, because you're physically integrating information. You're physically integrating information. So it's really important that I go over this to preface this training, because in order for you guys to get the most out of it, you want to make sure you're in the right setting, you're in the right place where you can go ahead and fully absorb everything that I'll be delivering over the next hour and 15 minutes, hour to hour and a half. Okay, that's the goal for the timeline. Not including Q&A. It's just the training and the delivery of the training. So if you guys are excited for that, go ahead and feel free to drop some 8s in the chat. 8 for abundance. Yes, this video will be accessible later on. After I see some energy in the chat, okay, I'm going to give to you guys everything over the next, everything I can, everything that I feel is necessary when we're going back to the institutional training basics on today's session. So with that being said, we're going to go ahead and dive into the disclaimer, because you guys already know if I don't do that, then I'm going to get fired, right? You're off the platform, Donnie. Get out of here. No disclaimer, you're toast. So let me pull this up. I say that jokingly, but it's like you have to, as an educator, you have to pull up the disclaimer, right? So chat is set to host some panelists. I do know that. I'll be turning it off completely in a few minutes. Let me pull up the disclaimer here. All right. What's funny is, now that I have a MacBook and my at-home PC, it's weird, because like I have 2 different desktops, you know what I mean? So it's like I have things saved in different places on both computers. It's kind of funny. So this is the here, let me close out this tab. You guys can see the disclaimer, I believe. So this is the disclaimer, right? This session, we won't be doing any live trading on this session. All right, this is just strictly in-depth, very thorough training, but still not financial advice. Okay, don't take any of this as financial advice. That's not what it's meant to be. However, this is for educational entertainment purposes. So we have a lot of fun. I do my best to make the education entertaining, but ultimately I'm here to teach you guys on today's session, not give you financial advice, and always consult, your financial, your people. All right, if you don't have people, always consult accountants or whatever the case may be. But that's the disclaimer out of the way. Okay, I'm going to go ahead and camera is laggy. Camera should be fine. Can you drop a 1 in the chat if you guys can see my camera and it's clear and we're all good? It might have lagged for a little bit there, but hopefully everything should be okay. Can you guys just confirm in the chat? It's black? Really? Interesting. Okay. Let me see if I can fix that. Okay, let me try a couple things here real quick. All right. How are we now? Are we still lagging a bit? Or is this better? If it's choppy, bear with me. Hopefully it's not too, you know what I mean? Because I'm like that guy where it's like, if anything about the production is like off, I'll get, triggered. Okay, perfect. Still nothing. You guys should be able to see me, no problem. Just make sure that, you've, I can't imagine why you can't see me, actually. That's bizarre. There's not even another panelist, so I can't pin myself, but okay, perfect. Most of you guys can see me, so that's good. So let's dive into it. Okay, today's session, this is the back to the institutional trading basics, and the chat is now disabled. So really focus and really hone in. If you haven't already gotten water, notebook, white paper, blue ink, and you've put yourself in a position where you can really integrate everything we're going to go over, in the next hour, hour and a half, be sure to do so. But what we're going to be talking about today is the foundational principles of institutional concepts, of smart money concepts. And there's a couple of things that I want to dive into that will be necessary prior to us really getting into the charts and that kind of, understanding on a visual level where you'll be, drawing diagrams and things like that. Okay. So one of the things that I want to pull up here to really put into perspective a couple of different things, because, just as some background, I'll give you guys this context real quick. When I first started trading in 2018, I saw a great opportunity. I was like, man, I want to increase my income without a second job online and potentially be able to do this thing full time. That's the vision that I saw with investing. As I was learning more, I was like, wow, this is possible. Like, people are doing this at a high level. And so I knew that I saw the vision. I knew this was very much attainable. I mean, I knew this was very much possible. It was just a matter of doing the right things long enough consistently. So I started to integrate and study and digest as much information as I could to learn to become profitable in the markets. My first, I want to say it was about 9 months, were completely independent. So I didn't have a mentor. I didn't have a community. I didn't have people I was working with. I was just locked into whatever study materials I could get my hands on, books, certain information online, baby pips, believe it or not, was something that I actually went through, YouTube University. And I found that there was a lot of great information, but it was nothing that could get me to a point of being profitable. There was still a missing piece. Maybe some of you guys can relate to that when I share that. You felt like you've been through a lot of information, but there's just something missing in you getting that breakthrough to becoming consistently profitable and really doing this thing at a high level. So I'll never forget, in 2019, I went to a conference, an event, okay, a function that took place in person. It was in Toronto, Ontario, Canada. And I met a couple individuals that I felt really aligned with. They just the vibe, you know what I mean? You just kind of meet somebody and you can tell based on their vibe whether or not you're going to click with them or not. So I met a couple individuals, clicked with them really well. And I started to, because they were already highly, highly successful in the world of trading. And I started to plug in as much as I could to these individuals. I identify people that, number one, had what I want, and number two, had been where I was. They've been doing this for years at this point. So they had been through the trials and tribulations that every trader faces to a certain extent, finding profitability, having a hard time, calculating risk, being, not so disciplined and blowing accounts. Okay. We've all been there. We've all been there, right? But the first principle that I want you to take note of, and this is a principle you can apply to trading and outside of trading, is number one, okay, write this down in your notes, is who do you listen to? Who do you listen to? Your goal is to listen to the right people, Because if you can listen to the right people, if you can surround yourself with the right individuals, you will be in a position to get the same results in a condensed time frame. That's what mentorship is all about. That's why you guys are here, right? There's so many people that you get the opportunity to plug into, and it's actually crazy the value that you guys have access to. It's wild. Don't take it for granted. So it took me 9 months to find those people. I couldn't find them before that. There were some other, people that I was learning from, and I'm very grateful for all of it, but there wasn't like my people, you know what I mean? So I found these individuals. They have what I want. They had been where I was, and those are the two points under who do you listen to? That's the first thing. Who do you listen to? Number one, people that have what you want. Number two, people who have been where you are. It's very important. So now you might be like, okay, so what you're saying, Donnie, is we should listen to you, right? And sure, maybe, right? You might want to, maybe, potentially, but that's not really what I'm getting at. You can listen to whoever meets those two characteristics and two definitions of who do you listen to or who you should listen to. So there might be some people that have what you want in certain areas of life and maybe not in others. So you can have multiple mentors, right? And that's the beautiful thing about the platform is there's multiple educators that have their own style, their own swag that you can plug in with. Okay. But that's the first thing I wanted to touch on is who do you listen to? So 2019, this was the moment that I actually had the proximity that I felt I was missing to a community, to a support system, and not just that, but to people that have what I want and had been where I was. So I started listening to these people and I started to see what was going wrong in my trading. And it wasn't because I couldn't see it before. It was because I didn't allow myself to see it before. As much as we're going to be here over the next hour and 15 minutes or however long it is, none of this matters if you don't allow yourself to be fully vulnerable and transparent and accepting of your results. You have to accept where you currently are. Financially, trading is obviously a financial game, right? We're engaging in financial markets. So you need to come to terms with yourself. If you're broke, trading is not the solution for you. Sorry. I'm just going to tell it how it is. Okay. Getting another job actually probably would be the solution for you if you're completely broke right now. Trading is meant to supplement your income and help you break into new levels that you haven't initially attained. But in order to do that, you have to be comfortable and not feeling under financial pressure. That's another thing I wish I learned back in the day when I first started. So, and I'm just going to be raw and real with you guys because that's what it is. But when we think about the intro to institutional basics, back to the basics is the title of this session. The concepts, because there was a missing piece in my trading. It wasn't just the accepting of the fact that I needed to work on myself to become more disciplined and needed to get myself more, dialed in on the charts and tracking trades and everything. There was a missing piece in my trading. What was happening is anytime I traded all kinds of strategies, break and retest, indicator trading, RSI, stochastics, Bollinger Bands, everything. I've been through it all. Trust me. Okay. Most of it, maybe not everything, most of it. I've never used like the Heiken Ashi candles or anything like that. But anyway, so you guys get the point. I've experienced a lot of different strategies. But the thing that stuck with me for a long time was, and I could never figure this out, I was like, why is it that certain setups play out and the same setups in different scenarios don't play out? There has to be a reason for that. Like, why is the market, hitting take profit here when it's like the same exact setup? Nothing's really different over here, but it's a stop loss trade. It's a stop loss. It's a losing position. And every single one of the strategies that I was trading prior, there was no answer to that question. The why, which I feel is probably the most important question you could possibly ask for anything. It's like, well, why is your business so successful? Oh, I don't know. I've been doing it for years, like you go and find like a successful basketball player and it's like, why are you, always draining free throws, never missing? I don't know. I just do it all the time, they don't even know. So for trading, it was like, well, why am I winning some trades and losing some trades when the market looks to be doing the same thing in both scenarios? Why? The question could not be answered. It's like, oh, the market just wasn't feeling like respecting your area of support today. there's a losing trade, right? So institutional concepts was introduced to me for the first time in 2019. And I'll never forget the paradigm shift that I experienced with my trading, because that question of why was finally answered. And I'll be honest, if you're seeing this, maybe you're completely brand new, maybe you've been here for a while, but understanding that, or having this understanding of institutional trading and institutional concepts is very eye-opening. You start to see a level of clarity behind why the market moves the way that it does at such a deep and profound level that once you see it, you will not be able to unsee it in the markets, truly. And I'm sharing that from experience, but also from hundreds of others, thousands of others who can relate and say the same thing when they come into information like what we're going to be talking about today. So I wanted to start with that. And now let's really put into perspective a couple of different really important things. I'm going to share my screen. We're going to go into this, and there's a few things that I want you guys to take note of. For this section, if you want to take screenshots just for reference and notes, of course, you're welcome to. But again, when it comes to integrating information fully, it's better to write down what you're being shared or what's being exposed on today's session and just in general. So first things first, okay? Maybe some of you guys have seen me pull this up before, but I like to reference this, okay? Foreign exchange Wikipedia page. And a lot of this is all, fact checked, and there's sources for everything. So that's one of the reasons why I like it. It's just kind of ironic how in school in North America, it's like frowned upon. Oh, you can't use Wikipedia as a source. It's like, what do you mean? I go to Wikipedia and it tells me where it's sourced the information, and now that's the source. You know what I mean? Anyways, it's kind of funny. So there's a couple of things I want to show you guys here. And this is to put into perspective some things that are paradigm shifting. Okay, when you think about these markets that we engage in. Now, this is for specifically foreign exchange, but understand that this is universal. Doesn't matter if it's crypto, doesn't matter if it's stocks, doesn't matter if it's futures, doesn't matter if it's commodities. This is applicable across the board. Okay, we're talking about the big fish on today's call, the institutions. So when we take a look at some stats and some data here, all right, 2022 central bank survey of foreign exchange and OTC derivatives market activity show that trading in the foreign exchange markets averaged $7.5 trillion per day. I think a lot of us are aware of that statistic. If you're not aware of that, now you know. And that's a massive number. 7.5 trillion is a absurd number. That is massive per day on average, which means that some days there's a lot more than that. Some days there might be a little bit less than that, but the average to be 7.5 trillion is huge. And this is up from when I was kind of first starting to learn this stuff, 6.6 trillion in 2019. And with inflation, it's going to continue to increase, right? So that's one thing. Okay, lots of money. Okay, there's 12 zeros in 1 trillion, and there's 7.5 of those being traded on average every single day. But here's the kicker, and this is, I think, the perspective that a lot of us need to really take more seriously, is the fact that the top 10 currency traders, all of which are major institutions, it's not an individual, it's not Warren Buffett, you won't see him in this list. You won't see, richest man on planet Earth, supposedly Elon, on this list, okay? I won't get into that conversation. There's definitely richer people than Elon. But anyways, take a look at this, okay? Market share. When we see these percentages, this is the amount, this is as of 2020, okay? So this could change, and we'll probably get an updated statistic at some point. But this is the market share percent. This is the amount of percentage of that average $7.5 trillion that's being traded per day. This is the market share that these institutions have of that 7.5 trillion on average per day. JP Morgan alone, massive American institution, owns or controls almost 11% of that 7.5 trillion. If we were to add up all 10 of these, okay, we're not going to do it to save time, but if you wanted to, you could take a picture of this and add it up in your own time. It's a number between 60 and 65%, which means that just the top 10 major institutions are controlling more than 60% of the entire trading volume in these financial markets. Yes, this is a foreign exchange statistic, but Newsflash, this is for stocks, this is for crypto, this is for every industry, every market. Okay, major institutional involvement cannot be overlooked for a couple of reasons. Let's think about this. Okay, think about it. And I'll open up the chat for a second for you guys to engage and let me know. And it's just going to be hosts and panelists. So sorry if you're trying to promote your WhatsApp chat, it won't work. Anyways, why do you guys think this statistic that I'm about to pull up on screen is the case? Or actually, hold on. Before I even pull this up, let me ask you guys a question. What moves the market? If you had to say, and there's different factors, of course, but ultimately there is one right answer that I'm looking for here. What moves the market? We're seeing the price of gold right now. It's like 29, 36, whatever, 20. Okay. What happens for price to be fluctuating, and ultimately, what is the main catalyst for the fluctuation of price over time? Okay, so I'm seeing a few different answers here. Banks, financial institutions. The institutions are fear, big investors, demand and supply, banks, liquidity, buying and selling. And then I see the right answer here. Money is the right answer. Money moves the markets. Think about this, right? We talk about supply and demand. Supply and demand, a lot of people might think that it takes a large number of people to be buying, let's say, gold for gold's price to appreciate, as an example, which isn't the case. It takes money to move the market. It's only money. Money is the end all and be all for market fluctuations. Okay, it's the end all be all for market fluctuations. So we could literally all be on this call and everybody takes a position on the same asset at the same time with, let's say we were all, millionaires on here, right? Every single one of us. We all threw like $1 million into a certain asset at a certain time, and we might move the market, maybe. But if a major institution came around, all right, your buddy JP Morgan, as an example, and they were like, all right, we're just going to throw, I don't know, 10 billion into this particular asset. Okay, XYZ asset. You insert whatever asset you want for the example. That is going to have a more profound effect than 1,000 of us throwing 100K, 200K, $1 million into that same asset. The 10 billion that's coming from that major institution is going to have more of an effect than the vast majority of us all that are retail traders. So for some reason, my monitor went off. Let me see if I can fix this real quick. There we go. So the reason that I share that and showcase that and start with this is because it is absolutely the truth about these markets that they're manipulated. And here's why. Okay, for statistics like this and what we just discussed, bringing that to light, it's no wonder so many traders in this statistic is the case with how many traders fail. Research suggests that approximately 70 to 90%, it's closer to 90%. I don't know where 70 came from. It's definitely 90% or more of traders lose money over time. Okay. So, and in some cases, it's up to 95% of traders fail, which means that the vast majority of people that decide to trade, the vast majority of people that decide to participate in the markets do not find consistent profitability. They do not find that edge or that strategy or that, approach to be consistently profitable. Most people fail. The reason for this is because they're not taking into consideration the big fish. And there's other reasons too, like lack of emotional discipline and stability. Like a lot of people don't take this as a profession, you know what I mean? They're kind of like gambling in markets instead of having a professional approach, right? Just being honest. But another major reason for that is because these major institutions wipe out so many retail traders before, ultimately making a fat bag themselves. Okay? Like I said, we could all everybody on this call, plus, you know, a ton of other people, right? All 1,000 of us, let's say, just as an example number, we could literally all go into one asset, purchase the same amount, let's say, in total, cumulatively, like 200 million of a certain asset, and it might fluctuate in price, you know, as a result of that liquidity coming into the market, that money coming into the market. All it takes is one major institution to bring in like tenfold that amount of money, one institution, one entity, and the market moves way more than all of us coming together and cumulatively, you know, buying an asset. So it's no wonder or coincidence why the vast majority of traders fail. It's because these guys are in control, and they have the ultimate control because money, think about it, money, you know, we're taught as kids, money doesn't grow on trees. It does. It's paper. You know, we've been lied to. It's plastic in Canada, so it definitely doesn't grow on trees here. But money can be printed and created out of thin air. These major institutions, they're not the creators of money. The Federal Reserve is, or the central bank in a lot of these different, you know, places, right? UK has a central bank. Canada has a central bank. It's all basically the Federal Reserve, but just for different countries. They are the ones that actually create money. And that's a whole another rabbit hole conversation. But the point is, if money controls the market and you control the money and how much is in circulation, how much you have, obviously you're going to set yourself up to win, right? Why wouldn't you? It's like, imagine, think about this for a second. Some of you guys are going to be like, oh no, like, I wouldn't do that. You know, like, I'm the good person. I'm going to donate, you know, everything. And you know, there's a lot of really successful people that are out here that are philanthropy, you know, focused, which is great. That's the goal. It's one of my visions. Very philanthropic. But unfortunately, these major institutions don't give a shit about you. Excuse my French, excuse my language. But it's true. They don't care about you. That's why there's so many people that just don't make it trading, because this is a challenge. Like, trading is not meant to be easy. Okay, you might think it is. This will really be a game-changing journey for you if you commit to it, but it is not easy. It's a challenge. But it is easier if you understand how the institutions have to position themselves and how they go about positioning in a very strategic and specific fashion in the markets, which we're going to get into today. Wanted to go over this quickly. The last thing I'll pull up just to really, you know, show you guys how crazy this really is some earning reports from major institutions. So this is information that banks, corporations have to literally by law share, you know, and document. And this is shared publicly too. So this is Bank of America Corporation daily trading revenue reported to the SEC. Okay. Now there's a couple of things that I'll show you guys in this screenshot, which is just crazy to think about. And there's two different years plotted on this chart. So you have the year of 2018 and you have the year of 2019. Okay. You have the revenue in dollars in the millions on the bottom, and you have number of days that they had, you know, profitability or trading days, you know, where they were making or losing XYZ amount of dollars. Check this out. They had a handful of losing days where they lost between 0 and 25 or 25 and $50 million. Okay. But take a look at how that compares to their profitable days. They had around the same amount of days where they made more than $100 million in trading revenue as they did in total for losing trading days, not including the, you know, close to 60 or 120 plus of, you know, 0 to 25 million or 25 to 50 million, you know, profitable trading days. It's crazy to think about. And you guys think they're doing this by accident? Of course not. There's no accident here. Okay. And major banks and institutions, here's a news flash as well. It's like, some of you guys are like, well, duh, obviously. Some of you guys are like, oh, I never thought about it that way. But here's a news flash for you. The banks are not here to help you make money. They're here, and they are companies that are striving to make money by lending money, by allowing you to borrow money, you know, by creating with the fractional reserve system, basically an infinite, you know, glitch, an infinite money glitch for them This is what they do. They're in the business to make money. They're not in the business to help you make money. There's just, again, like you go and talk to a bank teller, they are essentially just the hardest closing shark salespeople ever. It's crazy. They'll sell you on stuff that's like, it seems fantastic, but really it's they're trained without even knowing to be some of the hardest closing salespeople ever. And they do not have your best interest at heart. They don't have your worst interest at heart, because if they did, obviously they wouldn't be, able to get away with everything that they do. But these banks do not care about you. They don't. It's a part of the system that I believe holds humanity back in a lot of ways, the whole monetary system as a whole. And these are just institutions that are facilitating a lot of that, right? Here's another example quickly. I'll show you guys this one. This is from Goldman Sachs in 2017. And you can find newer, data. If you want to go through it, you can just go on the SEC website. You can type in earning reports, daily trading revenue reported to SEC. They'll give you, there's information you can find out there. But this is the same thing for Goldman Sachs, another American bank. You've got, again, daily net revenue in the millions. Here they had 79 days where they made between 0 and 25 million. They had 80 days where they made 25 and 50 million, 37 anywhere between 50 and 75 million, so on and so forth. You guys get the picture. Okay, they are highly, highly profitable. This is trading revenue. This isn't revenue from them, ATM fees. This is trading revenue. This is just trading. Like, you guys take that into consideration, right? This isn't everything that the banks are making. This is just daily trading revenue with these major banks. It's wild. It's wild. So there must be a method to the madness. When we take a look at this, the whole purpose of me sharing this with you guys is to give you the perspective that there's something fishy going on here. It's like, if the vast majority of traders are failing, retail traders, you and me and everybody else, it's an individual, but there's these major institutions that, like, man, they could go in on a bad day and still like suck at losing money trading. It's like they can't lose. Sure, they have like losing days, but I mean, it's nothing in comparison to their winning days. So how is it that they're doing this? What is the strings that are being pulled behind the scenes? Like, is this a game that's rigged and set up to, allow most people to lose? And actually the answer to that question is yes. Like, there's a reason that the statistics are the way that they are. And it's not to say that you can't find profitability if you decide to trade in a different style or without considering institutional trading. You can absolutely find profitability with any strategy, period. The biggest breakthrough in cognition for me in 2019 when I started to learn this was the why. I started to understand why the markets move the way that they do. And this is really the training that I'm about to get into right now with you guys on the charts, is what I hope you have the most cognitions and most breakthroughs with, and what I hope will give you that insight and the same answer to why certain trades will play out when certain, other trades with the same setup don't play out for you, or you get stopped out before it hits take profit or whatever. Okay, I hope that this can give you some more insight into that question that I knew, I couldn't answer, but I knew that it was an important question for years. And then I finally, through institutional concepts, was able to really have this breakthrough and this cognition. So the first thing that I want to start by doing, and this is, again, if you're taking notes, hopefully you're taking notes, taking screenshots, whatever. But one thing that I want you guys to do is write down verbatim, okay, word for word, the exact definition of liquidity as stated in the Institutional Trading Dictionary on screen. Okay, this is immensely important to understand. We asked earlier, okay, what is ultimately the cause of market fluctuation? And we all, or there was the response, everybody dropped responses, right? And the right answer, the only right answer, is money, also referred to as liquidity. So take a moment to jot down this highlighted text that I have on my screen. All right, if you don't have the Institutional Trading Dictionary, you can reach out to me on my Instagram. You can just literally send me the word dictionary as a DM, and it'll send this over to you, this resource. Okay, it's accessible to everybody. But liquidity, this is essentially another word for money, essentially. But liquidity refers to the availability of buy and sell orders at different price levels in the market. Liquidity refers to the availability of buy and sell orders at different price levels in the market. Liquidity zones are crucial as institutions often manipulate the market to grab liquidity. Liquidity zones are crucial as institutions often manipulate the market to grab liquidity, triggering retail traders' stop losses before making their actual moves. Triggering retail traders' stop losses before making their actual moves. Okay, I'm going to read this one more time, just all at once, because I already read everything kind of twice. Liquidity. God, hopefully, you guys are writing this down right now. Seriously, writing it. Okay, kinetics, writing physically, not typing. Please, I'm telling you guys, don't have time to get into that whole, the why behind that. But I'm sure you guys are curious. You look it up. It's crazy. It's crazy. Neural pathways in the brain. Liquidity refers to the availability of buy and sell orders at different price levels in the market. Liquidity zones are crucial as institutions often manipulate the market to grab liquidity, triggering retail traders' stop losses before making their actual moves. There's two types of liquidity. You can see this on screen as well. There is buy-side liquidity and sell-side liquidity. It's just a way of you differentiating between highs and lows, and there's just a differentiating, way of referring to them. It's all liquidity, right? It's really what it is. It's all liquidity, but buy-side liquidity could be clustered above swing highs or equal highs, where stop orders from retail traders are placed. Okay, stop losses. We're going to get into this, and I'll do a whole unpacking of this understanding in a second, because it's really important and it's also paradigm shifting. But your stop loss or take profit is no different than those pending buy stops or sell stop orders that you have the option to take on your MetaTrader or your CTrader or your TradeLocker or whatever, DXTrade, whatever you're using. Okay. So your stop loss is actually also a pending order, but it is specifically a buy stop or a sell stop. So again, we'll unpack that in a second, but institutions may push the price higher to grab liquidity before reversing. Sell side liquidity, inversely, it's basically the opposite of buy side liquidity, is clustered below swing lows or equal lows where stop orders are placed. In this case, sell stops. Institutions may push the price lower to trigger these orders before, again, reversing in the opposite direction. So hopefully you've had some time to write this down as we've been unpacking it, but essentially liquidity is part of what moves the market so quickly. It's not the money that's flowing in and out right now. It's the liquidity, the pending orders that are resting, that are in the form of stop losses, take profits, also pending entries, that the institutions will look to manipulate and capture to really move the market in the desired direction that they, have. Okay, so this is a really important definition to have. If you guys are good to go, you have this written down, drop a 1 in the chat. Okay, drop a 1 in the chat if you were able to write this down, the liquidity definition. You guys are good to proceed. Okay, I said verbatim. I mean, sure, you could put in your own words if you want, but it's good to have this definition in your notes. Here's another thing, right? This dictionary, when I first did this call in July of last year, wasn't even a thing. So we didn't do this. This is important because in order to have a deep understanding of something, you have to have these words illuminated. It's like if somebody uses a word that you don't know and you're like trying to mentally put the pieces together, but it's just like, I don't really know if that's what they mean or if they mean this or like, what is that word? So it's important. Otherwise, like that could be the difference between you being profitable and not profitable. It's like, you don't know what a stop loss is because you didn't read the definition. It's like, wait, is a stop loss? it's pretty self-explanatory, bad example, but you guys get what I'm saying. Okay, liquidity, really important definition to understand. And beyond just reading it in the dictionary, when you write it out, it further integrates this into your bank, your memory bank. Okay. So talking about this dictionary, I'll drop the link closer to the end of the session. I want to keep moving forward. So I'm going to turn off the chat again. Okay. Let's talk about it. Okay, let's talk about liquidity. Let's talk about something that was mentioned in this definition right here. Under the difference between buy side and sell side, the reason that it's called buy side, the reason that it's called sell side is because of the type of stop order that liquidity is. And we're going to get into this right now. So let's think about this, right? Let's pretend that we were taking a trade on gold. Pretending, okay? Just don't want anybody pulling trigger when I'm doing the training here. We're pretending. This is not a real trade, okay? I swear, you guys love gold so much. It's like I could just allude to an example and then somebody like pulls trigger on the trade and it's like, oh my gosh, you know, I made 20 pips while Don was doing a training. This is great. Oh man. Anyways, okay. So let's pretend that this is our setup. All right. We have a buy from this area. Stop loss is here. Take profit is here. I would suggest you guys to draw out a diagram. It doesn't matter exactly what it looks like. Maybe you have like a little, you draw like a little line chart in your notes, whatever. And you draw like, boom, you draw like exactly this. This is what we call a long position on the actual TradingView tool, but you can draw this in your notes and basically just identify, here's your entry. There's your stop loss, maybe beneath these lows. And, again, you guys can figure out what you think is going to be best for your own notes, but draw out something like this and label it to a T, exactly like I'm about to on my chart. And do this in your notes. Don't do this digitally. Okay, do this in your notes. I'm just doing it digitally so you guys can see the best way to go about it. And obviously, screen sharing is way easier instead of like sharing, I don't know, a piece of paper. Makes me think of like projectors back in the day. I think projectors back in high school. Anyways, it's like it's like your teacher's like drawn. Okay, digressing big time. So stop loss. And you guys are like, okay, Donnie, this is like basic stuff. Like I obviously know this stuff. Well, we're going to get to the paradigm shift in a second, or what was a major paradigm shift for me. Stop loss, take profit. Whoops. And then obviously you have your buy entry. Okay, so drop something like this out. Hey, if you want to go above and beyond, you can literally color coordinate this or color code this in your notes. Like color this in green for take profit, color this in red for stop loss. If you want to go the extra mile, you can get some markers or I don't know, pencil crayons. Okay, so this is the first thing you want to start by labeling with. Now, here's a very important definition that I want you guys to write down. And this is, actually, this is not in the Institutional Trading Dictionary. So I'll type it out and then you guys can just write this down as like a little sidebar in your notes. Okay, so draw this diagram, take a second, you can continue drawing it in a little bit. But we're going to go ahead and we're going to write down this definition, okay? When taking a trade, doesn't matter what the position is, and we'll explain this in more detail in a second. You have to do the opposite of what you did to enter the trade when you exit the trade, when you close the trade. We'll put close. So let's translate this into English because this kind of is complicated, right? It's like, okay, what does this mean? So when taking a trade, you have to do the opposite of what you did to enter the trade when you close the trade. Think about it for a second. If you're in a buy, all right, I'm in a buy position. When I close the trade, I am selling the position. When I'm in a sell position, which is really just for the record, and this hopefully this clears up this confusion, because I'll be honest, I didn't get it for a while, and it just didn't make sense. But when we think about taking a buy on something like gold against the US dollar, I am buying gold anticipating the US dollar to fall. When I take a sell on XAUUSD, I am buying the dollar anticipating the value of gold to go down. So me taking a sell, I'm still buying a contract, so to speak, but it's me stating I believe the US dollar is going to gain strength instead of gold. Okay. So even though it's called a sell position, you might think, well, how can I sell something I don't have, or how can I close a position when it's like it's a little bit confusing sometimes. That's what it is. When we're looking at currency pairs, you are always buying something. It's just when you're taking a sell position, you are buying the currency or the asset that comes second in the currency pair. Hopefully that makes sense. So in simple terms, if I'm in a buy, I need to sell to close my trade. If I'm in a sell, what happens when a take profit is triggered or stop loss, or I just close trade, here, okay, before either of those trigger. If I'm in a sell, I am now buying back the position, so to speak. Okay. So that's the understanding that I think is very paradigm shifting, because now, if we understand this, when taking a trade, you have to do the opposite of what you did when you entered the trade. When it's time to close your trade, here's what happens. Here's the mindset shift. All right, if we're in a buy, this is a buy example on screen. Your stop loss is in the form of a sell stop order. Okay, so your stop loss is a sell stop order. The same thing can be said with your take profit. Your take profit is also a sell stop pending order. The difference is, instead of you taking a sell stop, or in the opposite scenario, right, a buy stop to enter the market, it's what's being triggered to close your trade automatically for you. Either at a take profit, stop loss, maybe you adjust your SL to break even, whatever. Okay, it doesn't matter. If you're in a buy position on your trading platform, when you close it, you are selling. And it is a pending sell stop order when you have a take profit or a stop loss set. So this is where liquidity, the conversation about liquidity, really comes into play, because now if we take a look at this, what's on screen, I have a buy from here. Here's this low. I have my stop loss beneath this low. Okay. Not only do I have a stop loss beneath this low, but there are a ton of other traders that also have stop losses beneath this swing low. There's also a ton of traders that would be anticipating that, hey, if price breaks this low, I want to take a sell because we're, quote, taking out a key area of structure. So they have a pending sell stop entry order beneath this low. And then you have some people that are like, okay, if we break this low, that's a key area of support. If we come back and retest it, then I'm going to take a sell and anticipate price to go lower. Now, my stop loss being beneath this low, or someone else's pending order being beneath this low, is liquidity by definition. That is what we call liquidity, right? It refers to the availability of buyer sellers at different price levels in the market. Another way of looking at it is it's just pending orders that are waiting to be activated. It could be entries into the market. It could be exits for people closing out their trade. Either way, that is liquidity that, and we'll get into this in a second, that institutions have to capture to be entered into the market. Inversely, if you're taking a sell position, okay, I'm actually going to screenshot this for future reference. A little cheat sheet vibe, little cheat sheet vibe. You guys know me. I love cheat sheets. Let's do this. Boom. Oh, by the way, the reason that this low, we've identified this as an area of liquidity, okay? Because not just because I put my stop loss beneath this low, but because there's people with pending orders beneath it. There's people that are waiting for like break and retest. It is a key area in the market. It's a swing low. It's a low point prior to price making a high point. This is a swing high. So there's money on the other side of this zone for traders, technical analysts. The reason we call it sell side liquidity is because these are sell stop orders. Technically, and this is just specifically for stop losses, technically, if we look at this high, sure, I have a take profit in the form of a sell stop, but there's probably more people that might have sells with their stop loss above this high, which would be the form of a buy stop. So we call liquidity above highs buy side liquidity. We call liquidity below lows sell side liquidity. That's the differentiating, factor or way of referring to liquidity, right? You have buy side and sell side. Buy side is clustered above highs or relatively equal highs. Sell side is inversely accurate. So it's money beneath lows. If we're taking a look at a sell scenario, just to, make this easier, we're going to invert the chart here. If I can remember how to do it. There we go. Boom. Okay. Now we're going to draw another diagram. You might be like, Don, this is redundant. No, this is neural pathways being created. Okay. That's what's happening. Redraw the same diagram, but flipped. So now you have a sell entry with a stop loss and a take profit. Now it's like, okay, entry is here, take profits down here. Again, if you want to color this in green, cool. Color this in red, cool. Okay, stop losses above the high in this case, right? Take profit is at a low. You're anticipating price to go down from this zone. Okay. The only thing that's really changing is we've changed it from buy entry to obviously this is a sell entry. And now the type of stop order that your take profit and stop loss are it's now opposite. Because again, when taking a trade, you have to do the opposite of what you did when you entered the trade, when you're ready to close the trade. I really hope this is resonating. I really hope this is resonating. So if I'm in a sell from this zone, my stop loss is a buy stop order because I have to do the opposite of what I did when I closed the trade from when I entered it. Why is this important? Okay, I'll wait for you guys to, I'll explain this while you guys are drawing this out in your notes. This is important because when we see what we call liquidity grabs, liquidity captures, what's happening is the institutions need to take advantage of the liquidity that is left, in the market, but yet to be triggered to position themselves with massive orders. This is the next part of the lesson that I'm going to teach. We're almost there, probably another 20, 30 minutes. We'll be on here. This is the best analogy that I could give you. Okay. For you to take a trade, let's say it's with a standard lot. Let's say it's with, I don't know, Euro USD. All right, a standard lot on Euro USD. You have to have enough money in your account to drop that lot size, right? You might get a message that says, oh, not enough leverage or order canceled because you don't have the money to do it or you don't have the leverage to do it. You can't drop your standard lot. If you have the right account size, if you have the leverage to do so, when you go to take that standard lot trade, it'll place for you immediately. Okay. A lot of us have probably experienced that scenario where it's you went to take a trade, but it won't place for you because you don't have the account balance, number one, so it's too big of a lot size. Or number two, you don't have the leverage to open another position because you already have other positions riding or whatever the case may be. What the banks have as a problem is when they go to take a trade, money is not an issue, right? Money is not an issue for an institution, I'll tell you. Not that, I know because I'm not an institution, but obviously they don't have money as an issue, right? Money is not an issue whatsoever for a major institution. And here's something that really puts this into perspective. Okay. If you guys are OGs on it, you already know what screenshot I'm about to pull up, but this is to illustrate, All right, and continue to draw this diagram if you haven't finished it, right? Finish it up as I'm sharing this, but this is a cool picture a cool screenshot to maybe take a picture of. Okay, this is to illustrate the kind of capital that major institutions are playing with. Account balance, 49 billion. Some light, nothing too crazy, you know. Some light, nothing too crazy for an institution. I thought that's baby food for an institution. Smallest lot size, 80,000 lots. You know, again, some light, nothing too crazy. Biggest lot size is 1 million lots. Oh, that's on gold too. That's impressive. You know, he's up 53 mil on that position. You know, okay, right? So whether or not this is a real screenshot is irrelevant. The point is, these are the types of account sizes that major institutions are trading with. Hundreds of millions of, you know, in a lot of cases, hundreds of billions of dollars, if not trillions. There's 7.5 trillion that moves on average every day. JP Morgan controls just over 10% of that as of 2020. If we do the math on that, okay, so well, let's actually do this. I'm going to, you know, see what this number comes out to. 7.5 trillion times 10% is 750 billion on average per day from JP Morgan. So for them, if they're moving 750 billion per day, I'm going to assume that they're not full porting. Okay. I'm going to assume that they're trading with account sizes that are significantly bigger than that. Because let's be honest, like, you know, a major institution to be winning the vast majority of the time, making millions of dollars every day, trading revenue, like obviously, you know, it's not going to be, you know, you're risking 20% of your account per trade as a bank. Of course not. Okay, of course not. So, but this is to really illustrate, wow, this is a lot of money that these guys are trading with. When I say these guys, I'm just using, you know, that as a reference to the institutions. But here's the thing. The problem that they run into isn't, hey, you don't have enough money in your account to take the trade. It's, hey, you can't take the trade because there's literally not enough liquidity on the other side of your position. It's like a complete inverse scenario. It's like, instead of me not being able to take my trade because I don't have enough money in my account, it's, hey, institution, you can't take this trade because it's literally too big of a lot size for what is present on the other side of the market right now. Now, when there's, you know, when there's an agenda that an institution has to bring price higher or to bring price lower, they need to be very strategic to make sure there's enough liquidity on the other side of their trades. This is where the breakthroughs come through. Like I'm telling you, this is, I warned y'all to strap in for an hour and a half because this is where it gets real. This is where it gets real. What they'll do, okay? This is crazy. I'm telling you guys. I wish I could re-experience the breakthrough I had in 2019 when I learned this stuff. But it gives me joy, and you know, it's very fulfilling to see that same cognition that other people have when I share this with them, or from videos or from other people. You know, it's like duplication, right? Once you teach somebody this stuff, they're like, dude, this is wild. And then they share it. And then those people have breakthroughs and it's great. It's like a domino effect. We love to see it. But check this out. Okay, and I'll pull this up as a cheat sheet. Yeah, shout out to cheat sheets one time. Sorority concepts, institutional concepts, same thing. All right. Banks will sell to buy. Like, write this down in your, draw this picture. Don't take a screenshot of it. You can screenshot it too, but write it down in your notes, draw a diagram. Okay, it's crucial. Neural pathways being developed. Okay, really integrating this stuff, drawing the diagrams. But the institutions will sell to buy and buy to sell. They're doing both of these things all the time. This is what you call hedging the market. Why do they do this? Because they literally have to. They're trading with so much money that they have to hedge their way into the market. Because they can't casually, it's not like you and me where it's like when we have the account balance and we want to casually go ahead and drop a a few standard lots on a trade, which by the way, so I mean, if you're dropping standard lots on a trade with the right account size, you can be making a full-time income, handsome full-time income doing this. If you're consistently profitable dropping standard lots, it's $10 a pip. I mean, man, right? You guys do the math. You can do very well with standard lots. So you might have a, I don't know, 10K account, $10,000 balance account, dropping standard lots, and you're casually doing it because it's proper risk. You can do it. It's no problem. But what we're casually dropping as standard lots or micro lots or mini lots, the banks are, when they do it the right way, selling to buy, casually dropping millions of lots on trades. Millions. Guys, that screenshot I pulled up, the biggest position size was 1 million lots on a gold sell. The smallest position was 80,000 lots on an AUD pair. Do you guys realize how much money that is? 1 million lots on gold means that every pip is 10 million. That's a massive position. You know what I mean? But here's the thing. For them to take a 1 million lot position, there has to be enough liquidity for them to do it. So instead of them getting the error, hey, you don't have enough money in your account to take the trade, it's, hey, you're balling. We need to, there's not enough liquidity for you to enter the trade. Not exactly that way of, you guys get the point. So what they'll do to artificially create the capital or the liquidity that is necessary for them to take the trades is they will sell to buy, capturing liquidity. Oh, a seasonality screenshot. Capturing liquidity to then position themselves. Here's what this looks like. We're going to jump back over the charts. And there's a great example of this today on gold, actually. So we're going to use an example from today. Okay, we're going to delete this. Hopefully you guys got this written down in your notes. We'll keep a couple things, though. So, okay. Keep those off to the side for now. Perfect. So here we have the gold chart on the 15-minute time frame. The institutions have to sell to buy and buy to sell. Why? Because they're trading with so much money that even if they wanted to take a trade right here, right now to move the price in their direction, they won't necessarily be able to because there's not enough money in the market on the other side of their trades. So what they'll do, and it's not to say you can't, like just in general, you can't take a massive position as an institution. You can, but the thing is you're dealing with slippage. You guys ever experienced during a NFP or a high impact news event? Let's get some engagement in the chat again here. I want to open it up for you guys. How many of you guys have experienced what we call slippage, where you had a trade that was entered with a certain stop loss or a certain take profit, and instead of it getting entered immediately or closing immediately at the price you had set, it like skipped a little bit beyond that area? Drop a 3 if you've experienced that in the chat. It's like, here's my entry. This is where I had my stop loss set, but instead I actually got stopped out below that area. Or here's where I had my take profit, but I got taken profit up here. It was great. I made more money on the trade than I was anticipating. That's like I wish that happened more often. You know what I mean? Okay, but it happens. So think about it. For a major institution, this is like an every time occurrence if we think about it. Because when they're entering these massive positions, the reason the market will move so fast and like sporadically when it's like high impact news or other things are going on is because they are ripping through what's called an order book. I'm not going to go too deep into this, but this is an important reference to bring up. An order book is essentially put the illustration of those pending buy and sell orders in the market. So this is a good example on screen. This is one for Bitcoin, but this is something that exists in every asset class. So if there is a pending order in the form of an entry or the closing of a trade, right? Because you have to do the opposite of what you did to get into it when you're closing it to get out of it. These order books will actually show you, and this is not accessible to the vast majority of retail traders. Unless you're using a cryptocurrency exchange, they will show you the open order book. This is not accessible for gold. It's not accessible for currencies. It's not accessible for stocks in most cases. Some cases it is. But most of the time, this is like hidden information. But institutions have access to this all the time because it's like their trading platforms, right? They own all these brokers, right? It's like it's like one big house of elite institutional ownership. It's like we see all these like brands that are all owned by like one major corporation. It's like you think you're getting something different with like one brand to another, but it's literally owned by the same entity. It's like the same thing with brokers and trading. It's crazy. I'm telling you guys, it's like a little bit rabbit hole kind of conversation. But this is what we're up against. We have to understand what we are up against in the markets. So this order book will show you, hey, there's, the amount of Bitcoin that are accessible or currently sitting in pending orders at this price level. So slippage is when there's such a fast movement through the market and the order book that it will skip certain levels where there were pending orders, or it'll just skip because there are no pending orders in certain areas of the order book. It's what we call a light order book. So that's what slippage is. For us, we might only experience it during news or during a volatile time. But for a major institution to just take a buy right now because their entry isn't entirely being filled here, it's going to be spread out and it's going to be less advantageous for them. That is the response to why they must, or why they choose to sell to buy and buy to sell, to manipulate their way into the market effectively. So to put this into perspective, there's literally an example on screen right now that I'll show you guys from this morning. And we're going to go into the replay mode to illustrate this. Okay. So here we have an area of quote unquote support on gold. All right. This is a zone where I would say with confidence, a lot of retail traders are looking to buy from this zone. Here's another point that I didn't bring up before, but that's important. Where do the vast majority, and you guys let me know in the chat, I think it's still open. Yeah, it's still open. Where do most people go when they first start to learn about trading and investing? Where do they go? First place. Okay. I know the first place that I went to, but where do most people, if you had to guess, maybe you've experienced this yourself, maybe maybe you started the right way the first time with the company, right? But like, what's the platforms that they'll go to? Like, I'm looking for the platform names in the chat. I'm seeing some responses, which is good. But I'm looking for specifically platform names. YouTube. Okay, so lots of YouTube, right? Absolutely. Okay, Google, Bing, maybe not Bing. Just kidding. Reddit, all these platforms. Okay, all these social media platforms, all these search engines, TradingView, right? Here's the thing. What is easily accessible to a retail trader and investor? How about, for example, when you start to trade, you're like, oh, technical analysis, ooh, trading platforms, ooh, this, ooh, that, right? Eventually, there comes a point where you start to learn about these things, right? Chart patterns, okay? Support, resistance, trend lines, these guys, head and shoulders, rectangles, circles. I'm just kidding, there's no circles. But you guys get the point, right? This is information. Here's another thing. By design, easily accessible for free for any trader to come and learn. Or you pay for it, but it's all fairly accessible and out there. Why do you think so many traders fail? Is it because they're all trading according to the same or very similar? They might think it's different or it's packaged. It's like, imagine this. You get a Christmas gift from two different people, different wrapping, different packaging, and you're like fired up. You're like, man, I can't wait to open these gifts. You open these gifts, and unknowingly, these two people bought you the same present twice. It's just packaged differently. And you're like, oh, it's like you're not going to be like upset that you got two presents that are the same because you got to be respectful of mom and dad, or well, hopefully mom and dad communicated about what the presents were going to be. But you guys get the point. It's like you're all right, cool. I got two of the same gifts. Great. Well, here's the thing. That same kind of principle of the packaging looking different, but what's on the inside is actually technically the same, is the reality of the markets. Like everybody trades a different strategy, a different style, a different technique, and they're like, "Oh, my way or the highway because this is the way to do it." When it's like you're actually when you look at it, your entry and your stop loss might be slightly different than some other strategies, but for the most part, it's actually the same. Like support and resistance with these chart patterns, with break and retest, with trend lines, like the stop loss placement for all these traders is actually in the same place most of the time, or the same places, which is why liquidity and understanding these chart patterns is important, not to necessarily enter off of them. You can do that profitably. I know a lot of people that do. But it's more so to understand where and how these retail traders that have access to the same information for free online or in paid mentorships at a higher level, but still, very easy to manipulate information. Why do you think what we're talking about today is like providing cognitions for many of you? Like this information is not for free online. Actually, that's not true. There are a couple places where you could find some good information, but I wouldn't even recommend going there because there's still bits and pieces that aren't shared or laid out the way that we laid them out on these sessions, right? This is information that you guys let me know in the chat. If you were a major bank that was making, I don't know, on a bad day, average like 25 million in a trading day, just nothing crazy. Would you want people to know how you're doing this so consistently? Yes or no in the chat. Would you want people to be able to emulate the exact strategy that you have as Bank of America Corporation to make hundreds of billions of dollars in the markets? No. Because guess what? Now you have competition. Guys, the world of business is not sunshine and rainbows. Like, do you guys understand that? It's nasty when you understand what's really going on. You got businesses preying on businesses. You got, Snap in our industry, you got cross recruiting. You know what I mean? It's like, oh yeah, one team, one dream until, I'm not going to get into it, but you guys understand what I'm saying. This is how it is with corporations. This is how it is with major banks and institutions. Like they do not want people knowing this stuff and doing this stuff and having these understandings. That's why it's so difficult to find legitimate information about this stuff. Okay, it's way harder to find this stuff for free online. I'll tell you, you can find it. You can find it, but you got to use a lot of discernment. What I mean by that is not everything is what it seems. You have to really probe and ask the right questions and know that the source is legit. You got to know that they have what you want to be where you are. And beyond that, the information is real and valid, right? So, but anyways, all that to say, this is why this kind of stuff is not like spewed all over the place on search engines and so on and so forth. There's a reason this basic chart patterns, basic technical analysis, all of that stuff is there for free, because the vast majority of traders will start to learn the same way, number one, when they first start out. And number two, even though it's like packaged differently, different strategy, different style, different chart pattern, all the liquidity is still pretty much piling up in the same places and very easy to manipulate. That's what it is. That's what it is. So here we have, check this out. Okay. You guys ready? I'm telling you guys, it just so happens we had a really good example from this morning. Here we have an area of quote unquote support. Okay. What is a support zone? A support is where prices come to an area and bounce a number of different times. Oh, look, check out this zone. Donnie, this is a great support zone. I look at this and I'm like, you're right. We had one touch here, broke through it, came back, bounced, came back again, bounced, came back again. Oh yeah, trade a little bit lower, but still respecting the zone, bounced, bounced, bounced. Guys, this is 1, 2, 3, 4, 5 touches from a zone. A lot of people are looking at this with the mindset of, okay, cool. Next time we come down here, and even this time, like I bought this move and I'm putting my stop loss, beneath this previous low. Maybe I'm putting it beneath this low. Maybe I'm putting it, a certain number of pips, maybe 30 pips for my entry. Okay. All these traders have like different rules, same pip stop loss every time, 50 pips every time. All right. Whatever the rules are. Okay. Then you also have on the flip side, traders that are entering slightly differently, where it's like, okay, here's an area of support. Okay. If we break that area of support and maybe, trade down lower like this again, or come even lower than that low, I'm going to wait for the retest and I'm going to take sells here and anticipate we're going to continue lower. Or they anticipate, hey, when we break here, we're going to continue lower. I'm going to put a sell stop beneath that low. So notice how liquidity is being generated. Opinions are being generated for when price breaks beneath this low. So you have the buyers. Actually, let's pull this over because we got this here already. Okay, there's your buy entry, your stop loss, your take profit for your buy. This is just an example. You don't have to like redraw this diagram per se. You then also have the people that this is just based off the support zone. You could even look at this as like, I don't know, trend line, right? Kind of, I used to trade trend lines back in the day. And I used to base it off like candle bodies, probably not the best. I'm not as good at drawing trend lines as I used to be back in the day. I used to be a big trend line trader, but look at this. It's like, wow, look at this trend line, right? Cool. Some people are like bearish. Oh, we just broke the trend line, Okay, there's different opinions that are being generated, and liquidity is this is the thing that is absolutely true. We have liquidity beneath this low in the form of stop losses, in the form of people that are waiting, pending entry from that zone. Same thing with these two double, this is a double bottom, just in the same zone of an area of support. Like there's so many people that are looking to buy with their stop loss beneath here, and there's also so many people looking to sell if and as to when we break beneath these lows. You got break and retest. You've got, I don't know, like I said, the W pattern traders. You've got the all kinds of other strategies that I'm sure. I mean, we could look at like indicators too. Like if we throw on just for fun, just to understand where the liquidity is coming from. Here you got, I mean, this is probably not the best example, but you got maybe people are buying because of where the indicator is based at. It's like, oh, we're below this line, the 50, so buys are favorable right now. Or oh, when we come down here, then I'm gonna look for a buy, right? Maybe you got your Bollinger Band traders, looking at this. Okay, Bollinger Bands. All right, it's like, oh, we're testing this zone. If we come down here, I'm definitely buying again. All right, we're coming back to the bottom band. Okay, actually, we'll keep that on screen. So all of this stuff, this is crazy what we're about to see happen. All right. So check this out. What do the banks do? They have to hedge their way into the market. They have to sell to buy, buy to sell. Why? Because they're trading with massive amounts of money. Massive. So if we play this thing out, this is an example from this morning. Okay. This is like 2 a.m. London session. Watch what ends up happening. Two areas of relevant liquidity get captured. Dang it. My 50 pip stop loss buying from support just got taken out. Man, you can't even see the Bollinger Band anymore. It's like, wow, Bollinger Band is up here. I was buying off the bounce. And I think this Bollinger Band thing's a scam. Actually, now that it's another example where it didn't work for me. I'm just trolling. Okay. This is what retail traders are thinking. This is the thought process. It's like, oh, guess what? Your sellers, your bears come into the market. Okay. Here it is. This is London session. This is a classic London session liquidity capture and reversal, by the way. But you have the sellers that are like, oh man, we're breaking that area of support. Donnie, I'm taking sells. We're selling. I'm stop loss above this high. You know what I'm saying? I told you the top for gold was in at 29.50. I told you. We're dumping from here. Come on, you're telling me we're bullish from here? Look at this bearish candle. This is crazy. This is what we call, you know, the breakout lower with the engulfing on the 30-minute time frame. You know what I mean? We engulfed that. Dude, that's a bearish sign, man. Nobody's buying that. And if they are, they're silly, you know? So, and I'm saying this humorously, but this is the thought process and the justification people have for taking trades. It's actually funny. It actually is funny. Not just because I'm making it funny, but because like that's the thought process that I had when I was taking trades, you know, back in 2018, 2019. Right? But watch what happens here. And when you understand the actual behind the scenes of what's happening, by the way, I should have mentioned this earlier. Major institutions, this is not like Wall Street back in the day, where you're making calls, hey, buy this. Hey, sell that. This is all algorithms now. Okay. Oh, I don't have my Rubik's Cube in here. Oh, wait, I do. Big Rubik's Cube guy. I think it's actually buried in my bag, though. This is important. I gotta pull this out. It's good illustration tool. It's buried under notebooks, though. So here is a Rubik's Cube, right? The Rubik's Cube is something that is practically impossible to understand and to solve unless you know the algorithm. Okay. What is an algorithm? An algorithm is a series, a sequence of moves, like kind of like what I'm doing right now. Okay, let's see if the camera will focus. Right, it's a sequence of moves that will allow the cube to be solved effectively. Now, there's different algorithms, different ways to solve this thing. Like it's not like, you know, one size fits all and that's it. Like there's various methods to the madness. It's kind of like in math. There's different equations that you could use to, or an equation can be written slightly different to give you the same result to the same question, you know, long division versus short division. It's the same thing. It'll get you the same answer. But an algorithm is something that will allow you to have a deeper understanding of, in this case, a Rubik's Cube. The markets are run by algorithms, major institutional algorithms that are executing these sell to buy to sell motions for the banks. It's not any individual pressing buttons buy and sell. It's not like us. Okay, this is all algorithmic. It's crazy to think about. So this sell to buy, let's talk about and unpack what's actually happening here on the 15-minute time frame. What's happening here? We see 3 a.m. London session starts to break out. First 15, 20 minutes into London session, anybody that was buying from this support is now like, well, I guess it's not a support zone. We're going lower now, right? This is what we call a liquidity grab. All right. Now, we don't know it's a liquidity grab until we see price run the other direction. But we understand that liquidity must be captured and taken advantage of by major institutions so that they can get behind their position in a big way. Okay. And here's your, let's see the RSI. Where's the RSI? Yeah. So maybe if you were an RSI trader, you actually waited for the liquidity capture and bought down here. You know, wow, RSI trader might actually be profitable on this one. We'll see. Okay, so nonetheless, stop losses are being triggered big time. Stop losses are triggered here. Stop losses are triggered here. Two major relevant areas of liquidity have been captured now. Okay. We'll put a little X beneath that zone, those zones. All right. And what is happening when the liquidity is being captured? Okay. We understand that the stop losses for buyers, either beneath these lows, this low, certain, 50 pip count, 30 pip count, whatever, are being captured and taken out. But again, what type of order is a buyer's stop loss? Type it in the chat. All right. Type it in the chat. You guys can see my screen, right? Should be able to, no problem. But what type of stop order is my buy trade going to have for stop losses and take profits? Okay, I'm seeing a couple different answers in the chat. I'm waiting for some more. Okay, stop loss, take profit. What type of orders are these? And for this particular example, it's a buy entry, so it would be a blank order. A sell stop order. Yes, correct. My buy, as an example, with the stop loss at 50 pips or beneath this low or beneath these lows, okay, the stop loss is a sell stop order. Not only do we have sell stops in the form of a SL for traders, but you also have people that literally have sell stops to enter the market in this zone. There's also people that are waiting for, like I said, break and retest, right? Break and retest sellers, stop losses above this high, but ultimately looking to bring the market lower. Okay. Liquidity just got captured in a big way with this sell-off. Watch what happens as we see price reverse. Okay. 2 quick, liquidity captures. Price starts to develop some more. We continue playing this thing out. All right. It's printing, it's printing, it's printing. We're now back where we were just before London session, and price is breaking out in a big way. This is a classic example of the buyer getting stopped out, price going their direction, and them getting emotional and beating themselves up and being like, next time I'm not putting a stop loss. You guys ever experienced that before? You're like, maybe if I just took trades without stop losses, I'd never get my stop loss hit. It's like, it doesn't work. Don't do it. I've tried it. So, but this is like classic. You know what I mean? It's like, wow, I just got stopped out and now price hit my take profit. Like, come on, man. Bollinger Bands don't work. Clearly, RSI clearly doesn't work. Let me go on to the next strategy because it must be the strategy that's, the make or break thing. And this one sucks and da-da-da. All these retail traders are having these mental breakdown battles with themselves. And, it's why 90% of traders fail. Okay. Not just because of the, what I just shared, but also they just don't understand how the institutions have to trade. So here's the mindset shift. Okay. We know that sell stop orders got triggered. Let's take this one step further as we come into the end of the training today. All right. Delete some of this. We know that there was liquidity captured beneath these lows. All right. But here's the thought process. I'm going to pull up this screenshot once more. The mindset, the ideology is that institutional traders have to sell to buy, and they also have to buy to sell. All right. To capture liquidity, to position themselves that, is going to allow them to position themselves in the way that they want to drive the market in a certain direction. So here, if we take this example, we have an area of quote unquote support where there's already a lot of buyers, where there's already, ample amount of liquidity on the buy, like the side of the market where they can then take buys. All right. That, what will happen essentially is most people are buying, we're taught to sell, buy low and sell high. Okay. Well, here's a high point in price. Here's a low point in price, at least in comparison to what we're seeing on screen. This is high, this is low. Most traders are buying from the lows. So that means that there's not enough liquidity at a glance for a major institution to take a buy from this zone. If everybody else is buying from this zone, there's no way there's enough liquidity on the other side of their massive buying position. So here, what they'll do is they will drive the market lower. Selling is no problem for them. There's a ton of liquidity already on the buy side of things. People are buying from this zone. So for them to take a massive sell order, there's no problem. No problem, because there's enough liquidity on the other side. Like, who's going to sell at a quote low point in price, at least in comparison to where we were from Tuesday to today, Friday? This is the thought process. This is the understanding here. So what they'll do is they will sacrifice capital with this sell-off. This I would encourage you to draw it on your chart. Draw an area of support with liquidity, then draw a sell to buy diagram like the example that we have on screen. Now you can draw it in the form of a line chart. If you want to take some time to actually draw candlesticks, it'll take you longer, but you can definitely do that. It's a good diagram to have in your notes. But what they'll do is they will sacrifice let's call it 500,000 lot sell. Temporarily sacrifice a 500,000 lot sell to drive the market lower. It's no problem for them to take a 500,000 lot sell when a bunch of people are buying from these zones already, because that means enough money and enough liquidity is on the other side of their order and pending orders and everything. So they take a 500,000 lot sell. What happens as they're taking the sell? The market dumps. And this is just an example, right? Maybe it's more than 500,000, whatever. Just an example. The market starts to sell off. What else happens is as buyer stop losses are being triggered, what did we clarify? In order for me to close my trade, I have to do the opposite of what I did to get into the trade. So if I'm buying from this support zone all the way down as price is melting, wherever my stop loss is, whether it's beneath these lows, whether it's beneath this low, whether it's, a certain static pip count, 50, whatever, when my stop loss gets triggered as a buyer, it's actually adding even more to the sell pressure. So here's the crazy 200, 1,000 IQ play that the banks will pull. They will sell to buy. They're melting price, triggering stop losses, allowing for there to be enough money and enough liquidity on the other side of now their major buys. Okay, all throughout this zone, they're now accumulating buy orders as stop losses are being triggered, as sellers are being baited into the market, right? That's another thing too. Sellers waiting for this key zone to be broken through are now also entering the market, adding to the opportunity for the banks to accumulate buys now. And we'll call it, a million lot buys all throughout this zone. Okay, is where they're buying. Where's there it is, boom. Okay. So this is crazy. You know what I mean? Like we're almost to the end of the session here, but this is the mindset that is or the concept that is so paradigm shifting, because now we understand why these stop hunts take place. We understand why the market moves the way that it does. This sell to buy motion was an effort to capture liquidity to allow the major institutions to buy, because otherwise they're not able to position themselves in buys from this zone. They're manipulating the market. They're capturing liquidity. Okay. Now, additionally, the same thing vice versa. Here's another example. Here you have an area of quote unquote resistance. Okay, that price is rejecting from. We rejected from it here. We traded through it here, but came back down into the zone here. We then rejected here and here once again. Probably some traders looking at this as an area of quote unquote resistance to take sells. Excuse me. So maybe next time price comes up here, they have sells with their stop loss maybe above these two highs. Right. Well, what do we see here? A buy to sell. The same thing takes place. They sacrifice some capital, some liquidity to drive the market higher, triggering, in this case, these are buy stop orders. They're selling from these highs. There are pending buy stop orders above the zone to then very quickly bamboozle and wipe out a lot of traders. Quick buy to sell motion. So we'll see this happen time and time and time again. Every single trade that I take is out of an area where we've seen this type of sell to buy motion or buy to sell motion. Okay. Now, the way that we structure an entry off of a zone like this is very simple. And this is how we're going to end off the session today. And I'll give you guys some homework and some stuff to review before tomorrow's training. So here we have sell to buy, liquidity capture. We know we've taken a look at this, but here's an important thing to consider. Okay, and actually, this is you guys might laugh at this, but this is the truth. Major institutions actually don't use stop losses. Okay, their stop losses are the algorithms that run the market that they have, and so that's what will ultimately determine and dictate when their trades are being closed. But there is no set in stone stop loss whatsoever for a lot of major institutions. So maybe not all major institutions, but for a lot. So them taking a sell here, 500,000 lot sell somewhere like here, driving the market lower, probably, and this is not necessarily all at once, but it's like progressive sell off, sell off, sell off, sell off. Again, the algorithm is executing these trades and orders. And the algorithm, this is the thought process. The algorithm will continue to execute sells to the extent that, because this doesn't happen all at once, like this does happen progressively. And the algorithm's goal in this scenario is to get enough liquidity on the other side of the 1 million lot buys. That's the goal. As soon as that's done, perfect. They execute the 1 million lot buys, again, progressively over time. And then they're positioned. That's it. It's like, what is the goal? The goal is to get enough money on the other side of these major buys. As soon as that's done, boom, they run the algorithm. The buys start to accumulate. Again, it's not all at once. It's progressive. It's over time. And then they have to play the mitigation game. Okay. Another definition that I would encourage everybody to write down, we're going to go through this quickly, is mitigation. Quick definition, nothing too crazy. Write it out. Don't take a screenshot. You could, but I would encourage you to write it out. Mitigation is the concept, and it's actually a fact, the concept of institutional traders returning to previous unfilled orders, such as in an order block, to mitigate their exposure. Or, and I'll add this in, it's where they've entered positions, but they're holding them in drawdown and waiting for price to return to that zone to break even on any sort of leftover trade that they had open. Okay, this often results in price revisiting an order block to allow institutions to exit or add to their positions. So I'll give you guys a second to continue writing that out. So when we think about this, they just took, in the example we're about to pull back up, they just took a 500,000 lot sequence of sells to then take a 1 million lot buy, right? That same 500,000 lot sequence of sells remain open as price is now trading higher, which means they are in what we call drawdown. It means that their positions where they took sells are not currently profitable trades. They're experiencing what's called drawdown. Okay, so mitigation is what they will look to do. Mitigation, the simple dictionary definition, if we pull this up, is this. Okay, it's a partial excuse to mitigate. So actually, this is, yeah, I don't like that description as much. This is the best description, in my opinion. Best definition, right? The action of lessening in severity or intensity. So, or, in this case, it's like an act in such a way as to cause an offense to seem less serious. So in this case, when they have sells all throughout this, candle here, right? As prices bought back up, those sells are now in drawdown. Instead of them just closing their sells and allowing price to continue flying, because that's what would happen. They're in sells. They have to buy. It adds to buy pressure when they close those sells. They don't want to close for a $26 million loss, which is the example that we have in the MT4 screenshot that I'll pull up again, right? For a major bank to take a $26 million loss, unless they absolutely have to, they're not going to close this trade. They're not going to close that. Unless they absolutely have to incur the loss and it's being outweighed by, let's say, a $68 million win or something, maybe then they would take it. But in most cases, the institutions are so well established with these algorithms that they will wait for price to come back to where they took the majority of their sells to, quote, mitigate that potential loss that they otherwise would have incurred, breaking even on their sells to then drive price higher. So here we have the concept of order blocks coming into the picture. We're not going to talk too much about them today. We're going to continue tomorrow with that. But here you have the last few consecutive down close candles in the form of an order block, where price then returns, giving entry opportunity. If we understand how the banks trade, we can enter and trade with them with very little drawdown, with sniper entries. Okay. But let's just say, this is what we were wanting to do, was enter off the order block, last down candle specifically that did the most damage prior to this up move. Okay. Sell to buy. We won't even pretend to structure an entry off of it for now, but that's what you could do. Watch how price returns to the zone where the most damage was done. This last down candle, we return to it right here, very temporarily. This is where mitigation takes place. Them having taken sells all throughout this down area, they then get their big buy position in from the lows. Price trades higher. We then return to that area where they had taken those sells to mitigate those losses, to lessen them, reduce them, or potentially eliminate them entirely. Now, when they close that sell, I'm telling you guys, when you really, I know we're being very thorough in this lesson, but when you really integrate it and understand it and have that breakthrough, you'll know when you have the breakthrough. This is crazy. Like, they sell, capturing a bunch of people, stop losses, screwing over a lot of people to the buy, and then position themselves really nicely. And now that they have the buys in here, when they wait for the mitigation to take place, guess what? 500,000 lost sell. When you close those trades, it's adding to the buy pressure. It's adding to the buy pressure. That's why we'll see such a fast bounce and reaction from these zones, ideally, if they are in fact mitigation areas. So here, sell to buy, price returns, we get a bounce, and we fly from this area going into New York session. Okay. Now we're getting another pullback, but this is an example of a trade that you could have taken. Entering off of the mitigation zone, targeting a previous high as liquidity. Here's a high right here. There's your order block. We actually captured some liquidity on the way down again, right? And that's the mindset and the thought process behind this style of trading. Is it's understanding the institutions, how they have to sell to buy, or they have to buy to sell in order to position themselves. And of course, mitigation zones, where they're bringing price back to break even, where they're bringing price back to close out of those temporarily sacrificed, other side of the, market positions. That is where we look to enter mitigation zones, fair value gaps, things that we're going to, continue to talk about on a lot of these future sessions. That is what we're looking to enter off of. And it's all in alignment with the major institutions. So that was the lesson that I wanted to get into today. What you can expect and look forward to tomorrow. And I'm going to give you guys some homework, and we'll do some Q&A here to close the session. So if you have questions, now is the time to go ahead and drop them in the Q&A box for me, specifically the Q&A box. That's the only area I'm going to be referring to. But to give you guys an idea of what to expect tomorrow we will be continuing this conversation. We'll be looking at an example of sells, right? In this case, there's an example of buys. Well, technically they did both, right? Sell to buy. But we're going to look at some other examples. We're going to look at more examples like this. We're going to look at more examples on the other side of the market, buy to sell. Like this is a good one here, but there's even better ones we'll look at. And we're going to get more specific into how you can enter off of order blocks. And we're going to illuminate that word. What is an order block, right? And how you can really go about positioning yourself in a really big way for tomorrow's session. So that's going to end the training for today. Tomorrow we will be live with that at 11 a.m. Eastern Standard Time, which is 8 a.m. Pacific. I believe that is around 4 or 5 p.m. UK time, you will not want to miss tomorrow's session. If you got value from today, definitely take the time to refer to the ECA Masterclass calendar to join tomorrow, because the direct Zoom link will not be dropped on Telegram. Period. Okay. So do what you got to do. If you're not a member of Economy and you're on this session, well, first of all, I hope you enjoy it, because you shouldn't even be here, right? Technically. But do what you got to do to be an actual member and join tomorrow, because tomorrow, this is the tip of the iceberg. Like, we had a good time today. This is good training, good value. But if you don't know how to actually apply it, to take the trades, to position yourself, all of this is for nothing. So you're without tomorrow's training, it's like you might not really be able to do anything with what you just learned today. So the link will be dropped on SolX. But ideally, it's not even dropped on SolX. Like, the link shouldn't be dropped whatsoever. It should just only be accessible through the masterclass. So, okay. The ECA bugs should be completely worked out. Like, there shouldn't be any issues, to be honest. But both recordings will be posted on the ECA, today's and tomorrow's. Okay, so we're gonna get into questions now. Questions in relation to the training specifically. And so I'm gonna go into the Q&A box, and we will pull up and answer some questions before I end this session. If you got to bounce, I know we've been on here for a little over an hour and a half, actually. So appreciate you guys for sticking around. Hopefully you guys got some value. But the recordings will be posted and accessible, so you guys don't have to worry about that. Okay, so let's go into Q&A here. So let's see if this individual is still here. I'm going to see and make sure everybody's here that asks questions. Okay. Why is liquidity not the lower low at 29.15, 29.16? For golds, technically every swing low is an area of liquidity, right? What we're waiting for is the capture of liquidity with evidence that institutions are on the other side of the market. So here we saw a sell to buy. Sure, there's this low here to the left. There's this low to the left too. Maybe this, low we could have captured. I'm pretty sure we did capture this one, actually. But the institutions only need to grab so much liquidity, because their goal is this, to position themselves in the 1 million lot buy. So if ever you're curious, like, why didn't we go lower than that? It's because they achieved what they needed to take that bigger buy position. Sure, this is still liquidity over here, and so is this. And you could still anticipate those to be taken out later on. But for what they needed to do today with trading, and what they needed to do as, a very complex series of algorithms, was done with that sell to buy, and then mitigation took place here. And that's a nice trade right there. Quick, easy, in and out on a Friday, right? So, when it comes to liquidity, there's always going to be liquidity. It's just a matter of identifying, okay, cool. After the liquidity capture, we've seen the reversal pretty aggressively here. We're waiting for the liquidity to get captured anyways. And then this to be what happens next before taking the entry. So that was a good question. Hopefully that helps clarify that. All right. This person's no longer here, so I won't be asking or answering that one. It was a question in regards to how to identify the right order block. Be here tomorrow. I will be going very in depth with this. So you won't want to miss that. This person's also not here, but it was a question in regards to where I'll be posting this recording. This will be accessible under the past weekly sessions tab, or under the advanced tab on my ECA. How can we know that the bank has already generated enough liquidity to buy? We can't know until we see the evidence. Juan, this is a great question. We can't know until we see the evidence. So here, when we get almost that V-shaped recovery, that's how you can know, okay, like, this was definitely a liquidity capture. It's still very bullish overall market structure. We just wait for that pullback and mitigation, and that's where you take the buy. Right? Otherwise, you might try and catch a falling knife here, and we could go lower. That's why you want to kind of wait for that evidence before taking the setup. Somebody asked, so what's the best strategy to analyze the market? It's what we're talking about, in institutional concepts. Obviously, there's so many different ways you can go about profitably trading. There's no, it's not a one size fits all conversation. It's more of you got to find what works for you. My preference will, of course, be to trade with an institutional mentality. It's more of a mindset than a strategy. Could you explain order block? Yeah, tomorrow we'll be getting into that, Tanisha. Great question. Are you trading Bitcoin? I do trade Bitcoin, yes. What do you mean when you say algorithms? Luke, great to see you. What I mean is basically code that is set to run for these institutions. For example, if you have MetaTrader 4, MetaTrader 5, there are what we call expert advisors, EAs, which are basically just code that you can plug in that will follow specific prompts that you've essentially given. Think of like ChatGPT, like you got to prompt it and then it'll give you responses. Coding is you prompting and setting things up. So if this, then that, it's like a whole, it's complex stuff. Like I don't even, it's over my head, coding and everything. But algorithms are essentially set to run behind the scenes as per the way they've been coded to execute these kind of bamboozle, buy to sell to buy motions. And it's like basically the algorithm is keyed in and set to do certain things to bring the value or the price of something to a certain level. I won't get too much into this conversation, but there's ways of you connecting the dots and seeing this in different markets. It's not a coincidence that like Bitcoin topped out at 69,000 last bull run. It's like kind of a meme, but it was also like the algorithm was set for that to be the case. Okay. It's basically like you'll experience to a certain extent like cognitive dissonance, where cognitive dissonance is like there's literally belief breaking information that you can that you will see and observe in the markets and just in real life in the world. Not that the markets aren't real life, but you guys know what I mean. Like real life, education system, politics, whatever. That it's like, dang, everything I once thought I knew about the education system is like this new thing that I just learned goes against everything I knew before. And you'll have like denial or cognitive dissonance about it. But the algorithms, the reality is like the market is fully pre-coded and determined. Like there is no, it's like the Matrix, that's that's the best way I could put it is like we live in a matrix, so to speak, in that when we're trading, it's like we're in the matrix. And it's like you got to understand how to read, how to understand the algorithm, how to go about positioning yourself with the droids, with the algorithms, droids. You can think of it like a droid, That's kind of what I guess that's the best way I could explain the algorithm. Great session. Appreciate it. Thank you for that. Glad you got some value. How can we distinguish how much liquidity institutions would need to grab to do their trades? You want to wait for the order block, right? Like wait for this last down candle or consecutive down close candles to print, followed by the reversal, to then wait for the retracement. There's your entry. And we'll be talking a lot about that tomorrow. Please drop the link on Telegram. Sorry, I definitely will not be dropping it on Telegram tomorrow. It's too much sauce, unfortunately. You got to be in-house. Still don't have access to ECA and Solex app. Have message support, no response. I'm sorry. Yeah, it's a challenge. It's a challenge. Maybe once you do have access, and it shouldn't be long. Like everything should be pretty well resolved, to be honest. I don't know why it's everything's unfolding how it's supposed to, right? But basically, even if you can't watch it live, like you'll be able to access the recording once you have access later on, right? And if not, like you can always message me on Instagram, right? We'll figure it out. If it's like just an accessibility issue or something, we're solution oriented out here, By the way, It's my Instagram here. You guys don't have me. Well, as I'm doing Q&A here. Will there be sell to buy or buy to sell movements in lower time frames like the 50? Absolutely, absolutely. The algorithm runs on smaller time frames, and you can see it very clearly on smaller time frames too. But yeah, you can follow the same information is applicable across all time frames. It's what we call fractal. It's applicable across the board. These institutional trades happen with everything, Eddie. This is a good question. They happen with everything, various pairs, like literally everything. It's wild, to be honest. Is that highlighted cell called liquidity void? Which highlighted cell? Were you talking about like this here? Sir, when do we do or what do we do with the GBP trade? I feel like we haven't been on this one's trade. Yeah, this month's been a weird month. Not gonna lie. We had a good start to the month. This week there wasn't really much, so I didn't, participate a whole lot. The GBP USD buy limit, is that the one you're talking about, Sir Millie? I'm keeping that personally. I haven't deleted it yet. The idea would always be to wait for liquidity to be taken. An entry point would be when prices has mitigated. Exactly one. Yeah, you got it. Smart money concepts is a strategy question mark. You maybe, yeah, you could. I guess you could call it a strategy. It's more of a mindset though. Smart money and institutional concepts is more of like a mindset. It's a way of thinking and seeing the market. What's your Instagram? Yeah, this is my IG here. Is that highlighted cell on the chart called liquidity void? I don't personally use the terminology of liquidity void. But potentially, I'm not sure if that's like a term that you use. Yeah, you could, maybe this is a liquidity void. Yeah, this can be used for trading synthetics for sure. For sure. 100%. What do you mean by algorithm for institutional trading? It's like instead of you manually executing trades, you have code and basically a bot that is coded to do very specific, and it's very advanced. Like we're talking super quantum computer, conversation. And that's the algorithm. That is, and there's multiple algorithms, but they all are coded from a major institutional perspective to do very similar things. Is that highlighted cell called liquidity? Oh yeah, I already answered that one. I'm not seeing a clear trend yet, based on what I see on the chart. Rather trade it with support resistance. Yeah, sometimes we'll be in consolidation phases and you can just go back and forth from a range, and you can do the same thing. Like here you have a quote unquote area of support. Here's like the top of the range, area of quote unquote resistance, maybe. Like you could take buys to the sells and just trade it inside a range for sure. You know, how do you trying to understand this question? How do you know way before liquidity influenced the market? I'm sorry, I'm trying to understand this question. If you could retype the question, I'll read it verbatim. It says, how do you stick one show weight before liquidity influenced the market? I'm sorry. I couldn't get that one. Usually I'm pretty good at like interpreting, but I've failed you on this one. But if you could type it to me more clearly, I got you. How many time frames do you use to validate your entry and exit? We'll talk more about it tomorrow, but multiple time frames, usually 2 to 3. Okay, guys, awesome. We've been on here for a while, so I'm going to wrap up this session. I think we've been on here for just about 2 hours. So we're going to call it for today. Tomorrow we'll be continuing where we left off today. And looking forward to seeing you guys there. Let your teams know. Accessible through the ECA calendar and Solex only. So if you're in the Telegram group and for whatever reason ECA and Solex aren't working, you can reach out and touch base with me. There's no guarantee I'm going to be able to get back to you before tomorrow anyways, but I'll be able to maybe send a recording or something, or we'll figure it out. All right. My goal is to make sure you guys get this information and can do something with it, right? The last question, it did get rewritten, I think. How long will you wait for liquidity to influence the market? Great question. I will wait for liquidity to be induced, for liquidity to be captured before taking a trade. So the how long will I wait conversation, it's like I will wait until I see it, you know. If I haven't seen a liquidity capture, I'm not taking the trade, point blank period. So there is no like right amount of time to wait or not wait. Price is going to develop. We're always going to be taking out and hunting one side of the market's liquidity more than the other anyways. So if we have like this low and this low, it's like either we're going to come and take out this one or we're going to go and take out these ones next. So you just got to wait and respond accordingly. Please reply me on Instagram. Yeah, I'll get back to you when I can. There's a lot of, like, I get hundreds of people messaging me all the time. So these sessions are the best place to come and ask me questions. Will be under the advanced class on masterclass. Yes. Yeah, it'll probably be under my advanced tab and past weekly sessions. So awesome, guys. Cool. Well, I had some fun. I love teaching this stuff. This is like one of my favorite things to talk about, and going back to the basics is really good stuff. So it was high popular demand, right? A lot of people were requesting that. So with that being said, enjoy the weekends, and I'm looking forward to seeing you guys tomorrow, 11 a.m. Eastern, 8 a.m. PST. I think it's like I said, 4 or 5 p.m. UK time. So let's have a great rest of the day, and go get some sleep if you're in, anywhere that's like, I guess that'd be Eastern side of the globe, right? Europe or something. Go get some sleep. I know it's probably like, I don't know, 12 for some of you. So, but yeah, and if you watch this all the way through on the recording, congratulate yourself for taking the time to do so and move on to the next recording. But take care, you guys, and see you all tomorrow. Cheers.